Good morning. It's Friday, the 29th of November, and this is Govindraj, Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. We're heading to the end of November and the beginning of December, the last month of 2024. Of course, you know it, but then it's always surprising that a year or all these months have gone by so fast. And that also brings me to the point that we do not have a take for today, and that will be back next week. So the top stories and themes. The stock markets are demonstrating their weakness once again and dive on external cues. India's trade minister says we should wait till the Trump administration comes in before jumping the gun on tariffs. Where are oil prices going now as war tensions rise again? Another central bank-led gold rush has started off. And are unsecured loans flowing into India's stock markets?
This is the Core Report with Govindraj Ethiraj.
The markets take a dive. After starting the day on a somewhat promising and positive note, the stock markets took a U-turn and started diving more than 1,000 points down all the way. The fall was the steepest in nearly 2 months, thanks to information technology stocks leading the way and investors adjusting positions on expiry of monthly derivative contracts, said Reuters. IT stocks fell about 2.5% after US inflation and consumer spending data that came overnight suggested that interest rate cuts could be slower than expected. Slower interest rate cuts would mean that spending by clients in the United States, a key market for IT companies, could be impacted, according to Reuters once again. The Sensex fell about 1,190 points to close at 79,043. The NSE Nifty50 was down 360 points at 23,914. And there were other broader factors as well, including stepped up attacks by Russia against Ukraine, a fall in the US markets overnight again, and of course the absence of fresh domestic cues, which is of course a continuing factor. Broadly speaking, this would mean that the markets were looking for an excuse to fall or for the sellers to jump in again, even as buyers stayed away. Could there be upward cues for the stock markets? Well, it is possible if companies start hinting at or revealing signs of a turnaround in their sales numbers or profitability for the third quarter, which is from October to December, but that's a little while away. But on the other hand, as we spoke just a little while ago, time is flying and we're already and almost into December. Wall Street is also running somewhat flat now as the overall euphoria following Donald Trump's victory is slightly fading. Stocks fell in light trading on Wednesday as investors took some risk off the table following big November gains, according to CNBC, which also added that the S&P 500 snapped a 7-day winning streak. The Nasdaq and Dow Jones Industrial Average were also down slightly. Traders appear to be taking profits off big technology names that have obviously done well this year. And Nvidia, which, for example, was up more than 170% in 2024, was down slightly. Meta was also down slightly, but remember, it's risen about 60% this year. The companies that took a bigger hit were Dell and HP that fell 12 and 11% after providing weak earnings guidance, according to CNBC. The rupee holds at a weaker base. The Indian rupee weakened on Thursday to close very close to its all-time low, pressured by foreign portfolio outflows and month-end importer demand for dollars, even as intervention by the Reserve Bank of India, or RBI, India's central bank, helped limit losses, according to Reuters. The rupee closed at 84 rupees 48 paise against the US dollar, which is down from its previous close of 84 rupees 45 paise in the previous session. The all-time low that was last week was 84 rupees 50 paise. So you get the band now. Meanwhile, Bloomberg is reporting that Indian banks suffered a deficit of liquidity this week for the first time in 2 months as dollar sales by the authorities to support the rupee drained cash from the financial system. The Reserve Bank borrowed about 14,000 crores or about $1.7 billion of funds from the Reserve Bank of India on Monday. And apparently this is the first time they've needed this since September 25th, according to a Bloomberg index. Bloomberg also pointed out, interestingly, that liquidity conditions have deteriorated significantly from the beginning of this month when banks were parking around 200,000 crores of surplus cash with the Reserve Bank every day. All of this has pushed up the interbank weighted average call rate, a benchmark for overnight borrowing costs, to near the highest level since June. And that rate is about 6.73% last week, more than 20 basis points above the Reserve Bank's current repurchase rate of 6.5%, according to Bloomberg. India and America, friends or foes? That's a question mark. India's trade minister on Thursday said India was looking forward to start talks with the new administration in the United States under Donald Trump, who the minister said was a friend of India, and the country's ties with the United States were only getting better with time. The minister's comments come amid apprehensions that the new US administration may impose tariffs on imports into the US from all countries, which would naturally include India. Donald Trump also spoke of special tariffs over other special tariffs on Mexico and Canada and issued various threats against them. The trade minister pointed out, quite rightly actually, that over the last 10 years, across Barack Obama, Donald Trump, and Joe Biden, India's relationship with America has only got better. According to him, in a briefing that was reported by Business Standard, he said that we need not jump the gun and let the new government take charge, which, by the way, is January 20th, and express their formal and official view. In October, by the way, Trump had called India as the biggest tariff charger and threatened reciprocal tariffs. During his campaign, Trump had proposed tariffs of between 10 and 20% on imports across the board and a 60% on Chinese goods. Whichever way this turns out, tariffs were a key aspect of Donald Trump's campaign trail and is quite likely to be one of the first things that he does as president, and that's something that he's already seemingly gearing up for. So what do these trade numbers between India and the United States stack up to? A helpful note from CRISIL Market Intelligence just out yesterday says total merchandise trade with the United States touched $120 billion in 23-24. That's last year. Trade with China came to about $118 billion. So you can see how close the overall number is. But within that, there are some big differences. India's total trade in general has doubled over the last decade and risen over 1.4 times in the last 5 years. If you did not know that already, India has enjoyed a trade surplus with the US of about $35 billion, which means we exported more to them than we imported. On the other hand, with China, imports are higher, which means we import more from China than we export to them. More specifically, with the US, there's been a rapid growth in India's imports of mineral fuels, that's oil and gems and jewelry, while as exports of machinery, pharmaceuticals, mobile phones, semiconductors, other electrical equipment, and electronic items. So pharmaceuticals is obviously drugs and pharmaceuticals. India is a very large exporter of generic drugs, mobile phones, you know that already. Apple phones, among others, or rather mostly Apple iPhones, are now going from India to the United States. While from China, exports of cotton have dropped dramatically, while exports of mineral oils and machinery have also slowed. Imports, on the other hand, from China of a whole bunch of things, including, again, electronics and mobile phones, have obviously increased. Where are oil prices going? It appeared momentarily that a ceasefire between Israel and Hezbollah forces in Lebanon was going to reduce war tensions somewhat, and perhaps they have. But other forces of demand and supply have taken over. Oil steadied as OPEC, that's the Organization of Petroleum Exporting Countries Plus, is expecting to delay a production restart, a decision that would help stave off a looming supply glut. Bloomberg is reporting, adding that crude is struggling to find a direction in the last session before the US Thanksgiving holiday, as a ceasefire between Israel and Hezbollah that we just referred to and falling refined product futures countered bullish expectations that OPEC will choose to extend production curbs on Sunday, and more of that in a moment. Brent also steadied to settle below $73 a barrel, and that's where it is. Interestingly, the US inventories of motor fuel have reached the highest in more than 2 months in the Gulf Coast last week, according to fresh government data, which implied that diesel demand has plunged to a 15-year seasonal low. Prices for both fuels have also touched the lowest in more than a week, according to Bloomberg. There are other questions, including how winter demand is looking this year and other factors of supply and demand across the world. I reached out to Bjarne, Schieldrop, Chief Analyst of Commodities at SEB Research, part of the SEB Group, a large investment bank based out of Oslo in Norway. And I began by asking him how he was seeing oil price trends right now.
Yeah, I mean, we have seen that it's hard for oil to go below 70. And I think part of that is because we've seen declining inventories. And we saw that also yesterday in data for last week. You know, inventories in the US fell more than normal of the season. Yet again, not a lot. Especially crude stocks are now close to 40 million barrels below the 5-year to 2019. It's not a big surplus market as of today. It's all about expectations that it's going to be a surplus market next year, number one. And in combination that OPEC holds 5-6 million barrels per day in spare capacity and wants to put barrels back in the market. Those are the two bearish elements in the market. But as of today, I mean, it's a balanced market with OPEC doing nothing. So that's the one hand. In terms of the geopolitics, I think it's interesting. Immediately following Donald Trump being elected president, when that became clear, we haven't seen a single rocket from Iran towards Israel. And also, haven't heard any threatening words from Iran versus Israel. Rather, we heard that, oh, maybe we should stop enriching uranium to weapon grade. It's like total change in attitude from Iran following election of coming president Donald Trump.
Right. So you talked about two things, the bearish factors. One is the perception of a surplus market next year, and the second on whether or not OPEC will increase production. So a decision on that has also been postponed. Is that correct?
Well, I mean, they postponed it. First, it was planned to happen in October, and then it was supposed to in November, and then in December, and now they talk about what to do in January. And I think the markets fully expect them to cancel production increase in January as planned by 2.2 million barrels divided by 12, some 180,000 barrels per day in that month. But the fact that they actually are postponing the planned 1st of December meeting shows that they are not full agreement of what to do. Will they or won't they? And suddenly they need more time to discuss more. And essentially that should be bearish for the market, saying, okay, the risk that they increase is actually higher suddenly.
Right. So, Bjorn, if you were to take a small step back, how is the overall winter demand and supply situation looking like? I mean, is this a tougher winter? Is it better than last year?
Normally, you see that demand is actually weaker in the first half of the year and then stronger in the second part of the year. That is the normal pattern. So as an effect, one should expect to see oil prices being bearish in the first half of the year and bullish in the second, but that is actually opposite. Very often you see that oil prices rally through the first half of the year into Northern Hemisphere driving season. That is the normal pattern. But since we know that demand is falling from Q4 to Q1, staying weak in Q2, then OPEC usually is very tentative to making sure that you don't have a big, unseasonally big inventory increase, because that is the seasonal norm, is that you actually do build inventories. So you want to avoid building more than normal inventories in the first half. So, now we are talking about the first half, we're talking about January, and we're talking about normal inventory rising, and OPEC wants to probably avoid a big rise, a big increase in inventories.
Right. Last question. This is the first time we are speaking after Donald Trump's election. And since you mentioned him, now, one of his campaign pledges, of course, has been to increase production of oil, including through fracking. And US is already the world's largest producer, and prices are where you said they are. So what does that mean? I mean, or rather, what is the market expecting? Will companies actually want to drill more and produce more, because they seem to be already doing that?
Exactly. I completely agree with you. I mean, Biden administration hasn't held back shale oil players at all. I mean, they have increased production significantly under his watch. So yes, there have been some restrictions here and there, but overall they've been free to increase production aggressively, and they have done so as well. So I don't think that there's anything holding back US oil production. And as such, whatever Donald Trump says is not going to impact them to make more oil. And, they fully understand the situation today. OPEC has a massive amount of spare capacity. We heard these statements that the US should increase by 3 million barrels per day from here. It won't happen, because shale oil producers are not stupid. Because if they increase by 3 million barrels in short time now, OPEC wouldn't have a choice but to go for volume, because if they don't get, they cannot sort of shed more market share. They have to sort of move back at some time. So the only consequence of US shale oil producers lifting production by 3 million barrels would be a sharp drop in oil price. And then what happens when prices are low? Shale oil production falls rapidly. So rather than gaining 3 million barrels per day, I think shale oil producers would lose 3 million barrels if they try that kind of strategy.
Right. Bjorn, it was a pleasure speaking to you. Thank you so much for joining me.
Thank you very much. Have a nice evening.
Central banks go for gold. More central banks are trying to hedge themselves against the uncertainty of a post-Trump world. Bloomberg reports that a whole bunch of East European nations are now buying up gold, and they range from the Czech Republic to Poland and Serbia, which are stocking up on gold and are also one of the biggest buyers of the metal, in turn driving up prices. In general, of course, central banks around the world are stocking their gold arsenals, as Bloomberg says, as a shield against external shocks such as prospective trade wars brought on by Donald Trump's second presidency and geopolitical tensions in Ukraine and the Middle East. But Eastern European monetary guardians, says Bloomberg, have made a particular show of topping up their gold piles. Are bank loans flowing into stock markets? So here's the backdrop. 9 of 10 individual traders lost money in the futures and options, or F&O segment of the stock market, in the 3 years between 21, 22 and 24. A study by the Securities and Exchange Board of India, or SEBI, said recently some 11 million retail investors lost about 180,000 crores during those 3 years, or an average of 2 lakh rupees per trader. In 24 alone, that's 23-24, the financial year, such traders lost about 75,000 crores. So this study follows the Capital Markets 23 study, that is a January 23 report, which found that about 90% of individual F&O traders again lost money in the year before. So the question that many have been posing in the last year or more has been that are people taking money through unsecured loans to invest in the stock markets, or more appropriately in some cases gamble in them, particularly in derivatives? So there is some anecdotal evidence to this effect, but there are no clear official figures or acknowledgements. At a recent Business Standards Summit, former banker KV Kamath said the financialization of savings has been propelled by technology, but that's only one side of it, adding that people who've lost money in the F&O segment have come from the unsecured loan market. He said, that is why I think the Reserve Bank is right to caution on unsecured lending and end use of money that is borrowed from providers of funding. So, financialization is good, but I think rash activities are not good, and that's why the red flag is being raised by both regulators, he said. So what is all of this adding up to? I asked Tamal Bandyopadhyay, consulting editor at Business Standard, who wrote a column on this theme, from which I also borrowed the earlier mentioned quotes. And I began by asking him what was the answer to that question on whether unsecured loans were making their way into the stock markets.
A lot of people believe in this, particularly Mr. KV Kamath. On record, he has gone on saying that the money is flowing into the stock market, and that's a matter of concern. And to support his argument, what Mr. Kamath says or quotes is that the SEBI study. Now, what the SEBI study said between 2022 and 2024 financial year, it says that about 11.3 million retail investors collectively lost 1.81 lakh crore in the F&O trade. And in FY24 alone, this comes as 75,000 crore. I'm not getting into all the details, but it says that only 7.2% of individual traders made a profit over the 3-year period. And about 1% of individuals managed to earn just about a lakh after adjusting transaction cost. And then the key question which all of us are asking, where do these traders come from? What's their financial background? What's their socio-economic background? And the SEBI data throws up this interesting fact that at least 75% of these traders had declared an annual income or less than 5 lakh. So with less than 5 lakh income, how do you have the money to play in the market? So the presumption is this money is flowing into the stock market. And just one more addition to that, in a recent one-on-one conversation with RBI Governor Shaktikanta Das, when I asked him this question, his answer was, there is no hard data on this. There is only anecdotal evidence. And then he did mention that RBI had conducted a quick sample survey to get a broad sense of what's happening. That's all he said. He did not share the outcome of the survey. He says that it's very difficult to quantify how much money is flowing into the markets, but we have got a broad sense. So what Kamath spoke about, this money flowing into the stock market, SEBI data talks about what is the financial background of those F&A traders, and RBI governor talks about a survey being done. He refuses to give the actually what exactly the finding of the survey, but he makes it very clear that RBI has got a sense. So if you see all this in totality, yes, there is a concern that money has been, or rather had been, flowing in.
And had been, I think, is an important point here because the data that you're now presenting shows that because the Reserve Bank, in response to a potential excess in consumer borrowing or lending, has already tightened, as of late last year, tightened the risk weightages, making it therefore more expensive and more difficult for ordinary people to take unsecured loans. And all of that has worked because you're arguing that actually now, at this point of time, the personal loan segment is now started slowing down.
Yeah, that's it. You know what happened is in November 2023, Reserve Bank of India, what it did, it raised the capital requirement, so-called the risk weightage for unsecured personal loan from 100% to 125%, which means the banks, they would require more capital to lend to this particular sector. And that translates into a higher cost for the borrowers. The numbers what I'm talking about, the result is this till September 20th of this year. So if you see where the personal loan is flowing between, say, September 2020 and 2023 and 23 and 24, the past 2 years, I'm just looking into the sub-segment of the personal loans. Now, the personal loans for buying consumer durables was 9.8% in the past year, meaning between 2022 2023 September, which is marginally down 8.6% in the previous year. That's very marginally down. But if you see that for other personal loans, meaning which is not classified for what you are asking, no question asked, your end use is not monitored, that particular segment of personal loan, it's down from 26.3% growth in between September 2022 and 2023, from 26%, 3%, 26.3%, it has come down to 11.4%. 11.4%. So you see that less than half of it. So that's the segment we are focusing on, because within the personal loan, there are segments which are secured, like against loan against shares, loan against fixed deposits, so on and so forth, loan against gold. That's a separate story. But if we just focus on only other personal loans where the lenders are not keeping a tab, what is the end use of that personal loan? There it is sharply down. It had grown at 26.3% between September 2022 and 23. But in the subsequent year, between September 2023 and 24, the growth dramatically came down to 11.4%.
And you're also saying that NBFCs who borrow from banks and then lend onwards to all kinds of consumers are borrowing less, or rather, at least the growth in their borrowing has also dropped quite sharply.
No, it's not borrowing less. Banks are giving much less loan. In fact, when the RBI risk weightage, banks loan to NBFCs, because end use of such loan is the typically this unsecured person, etc., etc. So that's a thing. It has also dramatically come down. NBFCs in turn are gives a loan. So that when I spoke about that loan growth has come down, it's only the banking segment loan growth, not the NBFC segment. But that's a separate story. I don't have the numbers, but one number is very critical is this: the banks money flowing into the NBFC segment, the growth in that, which was 21.9% in between 2022 and 23 September, has come down less than half of it to 9.5%. So banks lending to NBFC is also less than half.
Right. Okay. So you've also talked about how, as a separate point and as a separate story, how the growth in housing as well as vehicle loans is down. So to me, that is quite interesting because obviously that reflects, let's say, the more discretionary part of the spending, but the kind of spending you would do because you need to and you're not able to. So what does that tell us?
The growth we have been talking about, I mean, we are just, it's a question of few days we'll get to know the second quarter growth. So essentially, this is not a very happy story. If the housing and vehicle loan is going down, I mean, till now we are talking about rural consumption was an issue, and then latest number we saw that rural has gone up now. But unfortunately, this is one of the signs that everything is not hunky-dory on the growth front. I mean, let's hope that the festive season has given a booster and we need to wait for the numbers. But yes, these housing loans and vehicle loans going down, the growth is going down, indicative of what's happening. It is not a very good story.
Right. Tamal, thank you so much for joining me.
Yeah, thanks.
And before we go, here's some feedback from you. And before I start, thank you once again for the time and effort that you take in listening to our show and then, of course, writing this to us. Milap Shah says, excellent commentary in bringing out the longer term, second and third order consequences beyond trade wars like the higher cost of borrowings. Sahil Arora says, been listening to your podcast for a few weeks now. The people that you call are highly qualified experts and the information you share is A grade. Thanks. Tarun Kumar Singh says, Mishra ji is always a treat to listen to, very succinct, clear and concise, very balanced and mature in his views, does not waffle, no verbiage and superfluous words or expressions. He refers to the interview by my colleague Pooja Mehra with Neelkant Mishra, the chief economist at Axis Bank. So thank you all for your feedback and comments and reports. I do look forward to interacting with you always. If there's anything specific you would like to hear or you would like us to cover, we will definitely put in our best effort. Meanwhile, thank you once again and see you soon. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.